us is Jeff Currie, Goldman Sachs Global Head of Commodities Research. Jeff, good to see you. Thanks for joining us.
Great. Thanks for having me.
So it's a great new note out, and you're saying this is just the start of a new structural bull market across the broader commodity space. Why is that?
Well, we think there are three components to it. One is we believe there's a policy-driven structural rise in demand, and that's being driven by the redistribution of policies, which is targeting lower-income households who systematically increase the consumption. Think about this. You stimulate a high-income household, they save it. You stimulate a low-income household, they spend it. We've seen the evidence with the recent retail sales. Second, lower-income households consume more commodities than higher-income households. Just think about this. A higher-income guy drives a Tesla, has a well-insulated house, and eats something like fish. And as a result, the impact he has on commodity consumption is far lower. In fact, we estimated it's 50 cents per dollar for a lower income and 35 cents per dollar for a higher income. So these factors create that big systematic rise in demand against a underinvestment in supply due to poor returns over the last decade. Plus, you have COVID with the negative oil prices, and then you put on top of that ESG factors, and you end up with a deficit. Now you're probably saying, hey, what about oil? Isn't some of all these spending and these, we call it green leveling, spending on green CapEx to level income, isn't that going to hurt oil demand? The answer is in 2024, 2025, not in the next 4 to 5 years.
So I noticed that on your list, gold, zinc, and cocoa don't feature as the commodities that you're most bullish on. Why is that?
No, cocoa and zinc are the ones we're not bullish on. And the reason why is that they are in surpluses. And what's unique about this, I mean, we're talking like 30 different commodities here. All of the other commodities are in sharp deficits. And the reason why they're in such sharp deficits is we have demand recovering, inadequate supply. The level of demand is above the level of supply. We're drawing inventories and markets are tight. And here's the key point why we raised our forecast. Because of these deficits, many of these markets are in what we call a backwardation, where the spot price sits above the forward prices. You buy out on the forward curve and you roll up. That's the roll yield. So even if oil prices stayed where they are right now, you would generate a 17% return from the roll yield alone. And I think that's really key here.
Shepard Smith here. Thanks for watching CNBC on YouTube.